Imagine a financial system where troubled banks keep doling out salaries and bonuses despite drowning in losses and bad debts. That's the shocking reality the IMF is calling out in Bangladesh, and it's sparking heated debates about fairness and accountability. But trust me, this is just the tip of the iceberg. Stick around to uncover why experts are urging tough decisions that could reshape the nation's banking landscape. The International Monetary Fund, IMF, has voiced deep worries about Bangladesh's hesitancy in addressing the plight of nearly 24 banks grappling with huge capital deficiencies. In essence, these institutions are bleeding money from soaring non-performing loans, NPLs, that's loans where borrowers aren't paying back, leading to potential defaults, yet they persist in compensating their employees with salaries and bonuses. For beginners, think of NPLs like unpaid bills piling up. They weaken a bank's health, making it harder to lend money or grow, and ultimately risking the stability of the entire economy. The IMF is questioning this practice, wondering aloud why such financially strained banks aren't facing stricter consequences. This critique emerged during a key discussion in Dhaka yesterday, where an IMF team met with Bangladesh bank officials, led by Deputy Governor Zakir Hossain Chowdhury. The talks delved into critical topics like how banks categorize their assets, set aside funds for potential losses, manage credit risks, and apply regulatory leniency measures. Multiple attendees confirmed that the IMF reps were particularly blunt, probing why these struggling banks, burdened with high NPLs and gaping capital holes, weren't being shut down through liquidation. But here's where it gets controversial. Bangladesh Bank countered that bank closures are uncommon in our context, emphasizing a preference for mergers and gradual fixes. To illustrate, 5 banks have already been nudged into merger processes, while others are rolling out capital rebuilding strategies to claw back their shortfalls over time. Governor Ehsan H. Mansoor underscored this point, declaring, "We are in a completely free-floating position, there is no intervention in the market." Yet, the IMF team expressed skepticism, arguing that letting weak banks limp along indefinitely isn't viable and pushing for Bangladesh to map out definitive routes for either revamping, restructuring, or shutting down these institutions. And this is the part most people miss. The scale of the problem is staggering, with real-world implications for everyday citizens who rely on stable banks for savings and loans. Bangladesh Bank figures reveal that by June 2025, the total capital shortfall across the nation's banking sector had ballooned to over TK 1.55 lakh crore, up sharply from TK 1.10 lakh crore in the prior quarter. Among the 61 scheduled banks, 24 fell below the required minimum capital thresholds, including 4 state-owned commercial banks, 2 specialized ones, and 18 private commercial banks. For clarity, capital is like a bank's safety buffer. Without enough, it's akin to driving without brakes, risking crashes during economic downturns. Central bank representatives defended their stance by claiming no fresh loans had defaulted in the last year, attributing the current defaults to risky borrowing decisions made under the previous administration. This finger-pointing has ignited debates. Is blaming a past government fair, or should current leaders own up to inherited messes? Critics might argue it's a convenient deflection, while supporters see it as acknowledging long-term economic pressures in Bangladesh. Shifting gears, in a separate afternoon session, the IMF delegation confronted Governor Mansoor about the foreign exchange market, contending it wasn't truly free-floating, meaning exchange rates aren't fully dictated by market forces without government meddling. Mansoor firmly disagreed, reiterating, "We are in a completely free-floating position, there is no intervention in the market." When pressed on why the central bank was still buying US dollars, he explained that nations reliant on exports and remittances, like Bangladesh, naturally acquire dollars to maintain balance. Even powerhouse economies like Japan do the same, he noted. He further elaborated that with imports slowing and banks flush with foreign currency, purchasing excess dollars helps stabilize the market, preventing wild fluctuations that could hurt importers or exporters. Here's another twist that's sure to divide opinions. The IMF raised eyebrows over Bangladesh's approach to loan rescheduling, suggesting that reworked loans shouldn't instantly be deemed healthy. Instead, they recommended a cooling period, a watchful waiting phase to evaluate if borrowers truly mend their ways. But Bangladesh bank officials pointed out their current guidelines lack this, yet they insisted their rules for handling defaulters are tougher than many global standards, tailored to Bangladesh's unique economic challenges. "Our framework reflects the realities of Bangladesh's economy," one senior official stated, claiming IMF largely aligned with this view. This clash highlights a bigger question: should international standards override local contexts, or is customization key to sustainable growth? What do you think? Should struggling banks face the axe sooner to protect taxpayers, or do patient recovery plans make more sense in a developing nation like Bangladesh? Is the exchange market really free-floating, or is there hidden intervention? Share your thoughts in the comments. I'd love to hear if you agree with the IMF's push for tougher measures or side with Bangladesh Bank's defense.